Understanding your different choices. Money market. A money market refers to a sector of the financial market where short-term borrowing and lending take place among financial institutions and corporations. The instruments traded in the money market are typically characterized by high liquidity and low-risk profiles. Participants in the money market include banks, financial institutions, corporations, and governments. Key features of the money market include short-term instruments. Money market instruments have short maturities, usually ranging from a few days to 1 year. This short-term nature allows participants to quickly access funds or invest for brief periods. High liquidity. Money market instruments are highly liquid, meaning they can be easily bought or sold in the market without significant price fluctuations. This liquidity is essential for participants who may need to quickly convert their investments into cash. Low risk. Money market instruments are considered low-risk investments compared to other types of financial instruments. This is because they are typically issued by credit-worthy entities, and their short-term nature minimizes the exposure to interest rate fluctuations and credit risk. Common examples of money market instruments include treasury bills, T-bills, short-term debt securities issued by governments, commercial paper, unsecured promissory notes issued by corporations to raise short-term funds, certificates of deposit, CDs, time deposits offered by banks with fixed maturities, repurchase agreements, repos, short-term agreements where one party sells securities to another with a promise to repurchase them at a later date. The money market plays a crucial role in providing short-term funding to financial institutions, facilitating liquidity management, and serving as a platform for investors seeking low-risk, short-term investment options. CDs. A certificate of deposit, CD, is a financial instrument that represents a time deposit with a bank or financial institution. It is a type of fixed-term deposit where the investor agrees to deposit a certain amount of money for a specific period, known as the maturity period, in exchange for a fixed interest rate. CDs are considered low-risk investments, and they offer higher interest rates compared to regular savings accounts. Here are key features of certificate of deposits. Maturity period. CDs have a predetermined maturity period, ranging from a few days to several years. During this time, the investor cannot withdraw the funds without incurring a penalty. The longer the maturity period, the higher the interest rate generally offered. Fixed interest rate. The interest rate for a CD is fixed at the time of purchase and remains constant throughout the maturity period. This fixed interest rate provides predictability for investors, as they know exactly how much interest they will earn. Low risk. CDs are considered low-risk investments because they are typically issued by banks or other financial institutions with strong creditworthiness. The principal amount invested in a CD is usually insured by the government up to a certain limit, e.g. in the U.S., the Federal Deposit Insurance Corporation, FDIC, insures deposits up to a specified amount per account holder. Liquidity restrictions. While CDs offer higher interest rates, they come with restrictions on liquidity. Investors can generally withdraw their funds before maturity, but they may face penalties, such as the loss of interest earned. Some CDs also have callable features, allowing the issuing bank to recall the CD before maturity. Types of CDs. There are various types of CDs, including traditional fixed-rate CDs, variable-rate CDs, and bump-up or step-up CDs, which allow the investor to request a higher interest rate if rates increase during the term. Certificates of deposit are suitable for investors who prioritize capital preservation, want a fixed and guaranteed return, and are willing to commit their funds for a specified period. They are commonly used as part of a diversified investment portfolio, especially for those seeking a conservative approach to savings and wealth preservation. Stocks. A stock, also known as a share or equity, represents ownership in a company and constitutes a claim on part of the company's assets and earnings. When you own a share of stock, you essentially own a portion of the company. Stocks are a type of financial instrument that can be bought and sold on stock exchanges. Key characteristics of stocks include ownership. Each share of stock represents a fractional ownership interest in the company. Shareholders have certain rights, such as the right to vote on major company decisions and the right to receive a portion of the company's profits, known as dividends. Dividends. Some companies distribute a portion of their profits to shareholders in the form of dividends. Not all stocks pay dividends, and the decision to distribute dividends is at the discretion of the company's management. Capital appreciation. The value of a stock can fluctuate based on various factors, including the company's performance, market conditions, and economic trends. Investors may buy stocks with the expectation that the value of their holdings will increase over time, allowing them to sell the shares at a higher price. Risk and return. Investing in stocks involves risk, as stock prices can be volatile. However, stocks historically have provided the potential for higher returns compared to many other investment options over the long term. Market exchanges. Stocks are bought and sold on stock exchanges, such as the New York Stock Exchange, NYSE, or NASDAQ. Investors can trade stocks through brokerage accounts, either online or with the assistance of a traditional broker. Types of stocks. There are different types of stocks, including common stock and preferred stock. Common stockholders typically have voting rights and may receive dividends, while preferred stockholders usually have priority in receiving dividends but often do not have voting rights. Investors often buy and sell stocks with the goal of earning a profit through capital appreciation or by receiving dividends. Stock ownership can be part of a diversified investment portfolio, and individual investors can choose stocks based on their investment goals, risk tolerance, and market analysis. It's important to note that stock prices can be influenced by a variety of factors, including company performance, economic conditions, and market sentiment.